Let's talk a bit about FPI flows. Indranil Sengupta, economist and head of research at CLSA India, believes FPI flows will go up to 1% of GDP from the 0.4% they are right now. Very interesting note out there. Indranil, a very good morning. Great to speak with you and have you on NDTV Profit. I was going through your note, and it's a very interesting one. I want to understand first the whys and the by when. By when do you see FPI flows coming back? Because if you look at the data just in 2024 so far, FPIs have been selling, at least in equities, about 29,000 crores in equities have been sold versus a 60,000 crore plus purchase just in December. Why do you think the tide will turn?
Well, I think you should not look at it month on month, but over the fiscal, in which case you have almost $30 billion including debt. So I think that in the next few years, you know, next 2-3 years, we will see FPI flows average about 1% of GDP. I mean, it's not every year, but one year maybe much more, one year maybe much less, but we are in that zone already.
Right. Let's talk about the why. Let's talk about the rationale for why you have seen this. Looking at, and I saw this figure in your report that you had FPI flows go down to about 0.2% of GDP between FY15 and FY23. Of course, that's a function of the rupee and a weakening rupee. So is it safe to assume that a reversal in rupee will also fuel these flows?
Exactly. So, if you think about it, the RBI was building FX reserves till the GFC, and the rupee was actually appreciating because, foreign investors had the comfort that if they came in and left, they would not lose much on the currency. So, if you go back to the pre-GFC period or even slightly later, you find that FPIs were almost 1.3% of GDP, FPI flows. After that, we ran out of sufficient FX reserves, the rupee depreciated, and that led to a big fall in, FPI flows. In fact, I vividly recall a hedge fund, overseas hedge fund telling me that why will I go to India when, I will probably end up losing my all in currency depreciation. Now that scenario has dramatically changed. Mr. Das has built FX reserves. FX reserves are today $600 billion. And that's the level we think is adequate. And that's again bringing back FPI flows.
I just want to understand the context of it because you're comparing this to pre-GFC. Our forex reserves are getting better, and economy on the whole now globally recognized as relatively stronger, etc. But when you compare it as a percentage of GDP, our growth is also growing at a better pace, isn't it?
No, growth is roughly similar. If you take, in the last, I would say the last 20 years, growth is averaging around, 7%. If you leave aside the GFC crisis and the COVID years, otherwise it's averaging around 6.5%. So there is no change in growth per se. The big change that is coming is because uh, earlier we had high FX reserves which provided support to the rupee. In between, we lost that advantage, so the rupee depreciated. Now we again have rebuilt FX reserves, therefore the rupee should stabilize, and that will bring the comfort for the foreign investor.
So
So yeah.
right, please, no, continue that point.
No, like I'm saying that, we look at three metrics. Is your import cover 10 months? Do you have 75% cover for FPI equity outstanding? Do you have a 2x short-term debt external cover? All of the three lead to about $600 billion of adequate reserves, which is where we are.
All right. So we're sitting pretty as far as the bank is concerned. So FX reserves are giving that comfort, completely understood. But I also want to understand when you're saying that FPI contributions will come in, look at the equity and debt sort of breakup. And the focus has been more on debt recently, rate cuts come into the picture, etc. Can you tell us how you see that playing out? Will FPI inflows into debt consistently increase, or are we going to see another sharp upswing, at least in the medium term, as far as equity is concerned as well?
So equity FPI flows should be a steady story. You see, India's weight in MSCI go up vis-a-vis China, and so that's a pretty much discovered thing. When you come to debt, the fact that we are on the JP Morgan index, the fact that we may get into some other indices means that we will see good flows, another maybe 15-20 billion dollars of flows by March 2025 or so. So that's one. What is also more important to understand is that a lot of the debt fund managers in FPIs were investing in India at their own risk because India was off benchmark, they were not obliged to invest. So if something went wrong, the onus was on them to prove why they went into India in the first place. Now that is changing with India in the benchmark. What this will also do is bring in debt FPI flows into the credit market. Although, this is not the benchmark for that, but then once you have that justification, it's easier for debt FPIs to also invest in the credit market. So I think, therefore, that the 1% number that I have as both debt and equity, and I think debt flows will also be picking up, consistently, especially because the rupee should stabilize.
Yeah.
The RBI should be cutting rates, maybe 100 basis points by June 2025. So you get the advantage of FX gains plus the advantage of capital gains.
Wait, I'm going to come back to that and sort of get your view. So you're seeing 100 bips by the RBI by June. So no wait
2025.
by 2025. So
Yeah.
how soon do you think that begins? Are we going to wait for the Fed? Because the world is waiting on the Fed right now.
I think that the language of the Fed at least has to turn more definitively dovish for the RBI to act. But if you look at it this way, that if you cut rates, you support growth. And when you support growth, equity flows come in. When equity flows come in, the rupee stabilizes and the debt guys come in. So in India, because debt is barely 10% or even less, 5% of the overall FPI investment, paradoxically, rate cuts lead to more flows because they bring in equity flows. So therefore, I think there is as such no reason for the RBI to not cut now to support growth. But then I guess they will want to wait for a more definitive statement, maybe in the March 2024 policy, or let's see when, before they start cutting.
Right. So
But our
everyone.
call has been for April.
Okay. Your call has been for April for the RBI.
Yeah.
And for the Fed?
Fed is slightly later, September.
Okay, so that's interesting. We'll wait and see if the RBI precedes the Fed, and that consensus growing that maybe they should. I have very little time with you, but quickly want to bring in the China question when you're talking about FPIs. How much of it will also be determined by a China recovery and then a larger pool flowing towards emerging markets, hence India also benefiting?
So I think right now money has flowed out of China, hidden in countries like India. So any recovery in China will naturally first lead to flows back, but then also lead somewhere to a greater interest in EM per se. So at this point in time, I will say that a reversal in China will be flattish to marginally negative for India's FPI flows at this point, because already a lot of people have come here and China is cheap. So if China turns around, I think money will flow there.
All right. So if China's cheap, money will flow there. Might not be too positive for India, at least initially. Thank you, Indranil, for joining us. Always a pleasure speaking with you. Indranil there, with a very clear outlook that FPI flows in India will move up to 1% of GDP.